Now in this session we will cover this income portion. So if we talk about C corporation's income, first of all, obviously there will be business income, right? So whatever the main company's business is, so there will be sales, there will be cost of goods sold, so that you can easily calculate gross profit. Okay, now we will take each and every item in detail, what can be there or what cannot be there in gross receipts, what cannot be there in returns, cost of goods sold and all. But overview is that first thing is this gross profit. So gross profit you can get through so the gross profit means the normal business operation profit, so income through business operations. Apart from that, a company may have invested in some other company's share, and that company is giving them income in the form of dividends, right? So then there might be dividends. Inclusions are mainly related to we say foreign transactions. So if there is any company in foreign, for US the foreign will be other than US, right? So inclusions will be there. So this is what we will be discussing today. Apart from that, we have interest. So interest income, rental income, royalty income, capital gain. So basically the capital gain will be from buying or selling the assets. Then net gain or loss from 4797. So 4797 is nothing but the sale gain or loss from sale of business properties. Okay, business use property. So we might take schedule D and form 4797 in last, because it is again one of the major chapters that we may have to cover, right? And then some other incomes. So let's start like what all are there. So how gross receipts can be calculated or sales can be calculated, right? So first thing in this is what exactly includes in gross income. So gross income I have already told, these many things are there. So gross profit, income from other sources. Now if we start with gross profit or loss, so gross profit is gross receipts minus returns and allowances minus cost of goods sold. If we talk about gross receipts include all the sales that have been made from whatever business operations they have. So main business operation sales comes under gross receipts. Now there is a catch. There are certain things you need to keep in mind while considering the income for in gross receipts. First comes advance payments. So if you are an accrual method company or cash method company, you may have to record the payments, the income, when you are receiving the income. So it will include the income in the year of receipt. Advance payments means like you have not sold, but you are getting the cash. So whenever you are getting the cash, you have to include it as a gross receipt, because here we are not talking just about the sales, we are talking about gross receipts. Okay, so first thing is that advance payments needs to be included in the income of, in the year of receipt, right? Wait, let me see. Deferred revenue will not be there, so we cannot defer the revenue. Here advance payment will be there. So if you are getting the payment, you have to report it in the particular year. Now there are certain exceptions to accrual method. If you are following accrual method, so generally for long-term contracts, so for long-term contracts you have two kinds of methods you may use. First is percentage of completion method as per US GAAP, and second is completed contract method. So before going into this part, first of all, long-term contract means like for example construction business. So what happens? So construction cannot be completed in 1 year. So you may take 2 years, 3 years, 4 years to complete any kind of a big construction project. So what happens, you have two ways to recognize the revenue as per US GAAP or as per your books. First is completed contract method, in which you recognize the whole income at the end of the contract. Whenever you are completing the whole project, whenever you are delivering the whole project, at that time you will recognize the whole revenue. However, under percentage of completion method, what you do, on year wise you estimate, you will estimate the total cost that might be there and total revenue that might be there, and on the basis of that you will estimate the gross profit margin, and whatever cash you have received from the client for that particular year, you multiply it with the gross profit margin. That gross profit margin will become your current year sale or current year income that you have to show in gross receipts. Understood? So as per long-term contracts, accrual method people can use percentage of completion method, this, right? It is not available for cash method. So for cash method, obviously whenever you are receiving the cash, you have to report it. But for percentage method, you may for accrual method, you may use percentage of completion method. Okay, so this is one exception. You may use this for advance payment. So here, even if you are receiving advance payment, you are taking only the gross profit margin. Then limited deferral of advance payment. So limited deferral of advance payment is a concept, like if you are receiving the advance money from any client, but against that advance money you don't have the inventory in hand in particular year. So let's say in 2023 you received some money in advance for maybe, let's say, 100 bottles, right? Now if you do not have 100 bottles in inventory, you can defer your this advance payment. So in that way this becomes an exception, because you have received the advance payment, but as per law you have to report it in your income statement. However, since you do not have inventory in hand, you can defer it and show it as a deferred revenue, or accounts it will be negative accounts receivable for you, right? So this is how limited deferral can work. Then if there is any change in accounting method, let's say you were using some other method, maybe cash method to accrual method, or accrual method to cash method. If there is any advance payment adjustment because of the change in accounting method, then also you don't have to report it in the year in which you have received. You may take it in the next year if there is a change from accrual to cash or cash to accrual accordingly. But for that you have to file form 3115 for changing the accounting method, because it will be filed with IRS, in which IRS will give you the consent approval that okay, you can change the method accordingly. So this is one thing that you need to keep in mind for the advance payments, how to deal with it while doing the gross receipts. Then obviously rest, apart from advance payment, you obviously, whoever is following accrual method, that will follow that only. Whenever it is raising the money, raising the invoice, then they have to show it in the books or in the tax returns. Hence it becomes like advance payment or the recognition of the revenue, whichever is earlier, you have to report it in the income tax return. Then another point is installment sales. Installment sales comes into picture like if you are selling it, if you have sold a certain product and you are getting installments of that EMI basis, on EMI basis, right? So this is installment sales is not allowed for property dealers, of course. Property dealers or the ones who are dealing in personal properties as well, not just the real estate, but the personal properties also, those who are dealing in. So they cannot use installment sales. That means whenever they have sold. Let's say they have sold the property of $200,000 to the client. So whenever they have done this, they have to report wholesale of $200,000 in the year they have transferred the property. No matter whether the client is giving money in EMIs or maybe in installments, it doesn't matter for property dealers. However, installment sale is allowed for those who are into farming business. So if in farming they are buying or trading the properties, in that industry you can use this thing, installment sales. Apart from that, for some disposition of timeshare and residential lots, you can you are allowed to take installment sales. Now, what do you mean by timeshare or residential lots? Timeshare here means like what happens in US. Let's say four people have four individuals, or not individuals here because we are talking about corporation. Let's say four C corps are coming together and buying a property. So if four C corps are buying a property and they have decided that for the first quarter C corp 1 will be having the possession of their property, that company might do whatever they want. Quarter 2 maybe C2, quarter 3, quarter 4. So they may divide the time zone according to their needs and use that single property amongst them. So that is how the timeshare works. So if there is any disposition, means selling of this kind of property, along with that residential lots. Residential lots means you have whole colony and you are selling the particular lots to the client, or you may have builder floors and you are selling floor wise to the clients. So in that sense, in both the cases, if you are getting income in installments, then you can use whatever you are getting as a money and to recognize it in that particular year. Okay, this is second exception. Third exception is non-accrual experience method, NEA. We call it as NAE. This is known as non-accrual experience method, NAE. So NAE means so first of all, this is available for accrual method corporations. So here it is, these corporations are accrual method. So those corporations which are following accrual method, first of all. Secondly, those corporations who are providing the services in the field of these health, law, engineering, architecture, we call them as personal holding companies, personal service companies. So these are the personal services that you may give. So as a company, if you are giving such personal services and the corporation is following accrual method, those companies or any other company who has less than $25 million as a gross receipt, average gross receipt, those companies are allowed to take the provision. So generally provision for doubtful debt is not allowed, but for these companies who are following this rule, they may take provision for doubtful debt as a bad debt expense in their books. So how it can happen? So depending on their experience, from their past experience, if they think that such certain amount is not collectible in future, so you can take that as an expense. So this leverage is allowed only for such companies, and for that they have to elect NAE method, method by using this again form 3115. You can elect NAE method to take provision for doubtful debt. Now how to calculate this? Because provision for doubtful debt you can take anything, right? But here what you have to do, here mainly NAE, you have to follow safe harbor method. So NAE book safe harbor method says that whatever allowances you are taking in your books of accounts, you take 95% of that, not complete 100%. Okay, so that is something safe harbor, because you are what, first of all, obviously, mainly it is 5% of the total debtors mainly. So you generally take in books of accounts as 5% of total accounts receivable, right? Now here it will be 95% of 5%. So you are taking as a safe harbor method. Safe harbor means you are taking the safest option from this, right? So that is NAE book safe harbor method. So whoever is following NAE method, they can take 95% of their book allowances. So these are certain things you need to keep in mind. If at all you came across with your clients like, okay, this is something related to this. So if you see anywhere in your client's books that, okay, he's into, the company is into health insurance, health services or law services, so you may give them the advice that you should go for non-accrual experience method and take safe harbor method and reduce your taxes by taking certain expenses which are not allowed otherwise, because provisions are generally not allowed. However, for NAE method, they are allowed to take provision of doubtful debt, right? So that way you can convince your client and make them yours, right? So this was for gross profits. Let me see if anybody unearned revenue. Yeah. Then this is this for this the amount will be here in 1A. Okay, in 1A the amount will be here. Then if we talk about returns and allowances, so returns and allowances generally include whatever cash or credit refund the company is making to the customers. So if the customer is returning the goods, you will pay either cash refund or you may give some credit refund, like, okay, credit voucher or something like that. So that becomes returns and allowances. Obviously it has to be reduced from the total sales or gross sales to reach up to the net sales. So gross receipts minus returns and allowances will give you net receipts, right?